Thank you very much, Thirachai, for joining our program.
You're welcome.
Yes, Thirachai, recently you wrote an opinion piece to Reuters in which you questioned the recommendations, of the Financial Stability Board and also the G20s over how the financial institutions should be reformed. Can you elaborate on that? It appears that there is a gap, between the financial institutions in the emerging markets and also those, in the developed markets.
The FSB and the G20 have been coming up with a lot of recommendations, but a lot of the recommendations are very much specific to the more advanced markets. Things like, the attempt to try to regulate the pay that bank executives get, the bonus, the yearly bonus that the bank executives get, that it should be staggered with part of the payment to be received 3 or 4 years in the future, or the attempt to try to improve on the system of and the process of securitization. That had been the weak point in the advanced market. These are important, to the developed markets, and I think they try to address the gaps and the weaknesses that were present before the financial crisis.
So you think that the new regulations,
a lot of these will not be relevant for the emerging markets as yet, because the business practice and the level of product complication in the emerging markets are much lower than the advanced markets.
Okay. So you think that the new regulations, if
in that the people involved, as well as the rating agencies, as well as the analysts, should bear this in mind, that a lot of the measures introduced by the FSB and the G20 would be the things to address the problems specific only to the advanced markets.
So do you think that the new regulations, if they were to be adopted, would add more costs or expenses to the financial institutions, particularly from the emerging markets?
For those, any type of regulations are bound to add cost. But of course, on the other side, there are supposed to be benefits in terms of consumer protection, in terms of protection to the overall system, to lessen the systemic risk. But in all countries, one has to balance between the benefits and the cost, and this is why, for some instances, this may be necessary, for the advanced market in order to plug the loopholes that existed. But if you try to implement the same type of regulation, like trying to control bank executive pay and bonuses, this will not be very much relevant to the emerging market, and it would only add to the cost.
Thirachai, in your article, you highlighted 3 major recommendations, that the emerging markets, would like to see. The first is the risk of interconnected, of the financial institutions. The second point is how to reform the shadow banking system, and finally, how we should deal with the too big to fail banking systems. Can we go through point by point on that? First, how the risk of the interconnectedness, of the financial institutions.
But these are the 3 points which I think, are immediately relevant to the emerging markets. The first one is the problem or the fact that financial institutions, are connected when they do money market dealings between each other. One bank will be a creditor of another bank, but at the same time, it will also be a debtor to the third bank. So what had happened in the past, when they closed down Lehman Brothers. They found that the amount of interconnectedness between the institutions turned out to be bigger than they thought. So there is a risk that when you close down the first bank, it may also pull down the second bank and the third bank. So the recommendation is that the derivatives transactions, which are the bulk, the bulk of these indebtedness of the interconnectedness. These, as much as the derivative trading as possible, should be moved on to the exchanges where they have central counterparty clearing. That the opposing balances, the debit and the credits can be netted out, so that if any bank fails, it can be unplugged from the system without affecting the rest.
And the
two is that of shadow banking. And this was the concern. The concern in the advanced market was that some of the securitization transactions might have hidden away the obligations of the banks out of the balance sheet. That was not proper. But in the emerging markets, we have to look at the activity of the banks when they sell investment products. Particularly from their subsidiaries, in their own groups, to the customers over the bank counters. There is a need to see as to how much of that, will be considered by the investors to be related, or to think that this is the bank's products, and we'll expect the banks to step in, when there are problems. And the third issue is the issue of too big to fail. In the in the new regulations, there now debate as to how to pay for the next bank failure. This in the financial crisis that had just passed, all the governments used taxpayers' money, but there is now various proposals that future failures should be different. In the U.S., for example, they say, if say they need to use public money to help bail out the banking system in the future, they will have the power to levy that expense from the remaining banks in order to cover the loss, for example. In the case of the Institute of International Finance idea, in that the bank creditors can also be bailed in order to bear some of these losses. So these, I think, are important issues that the emerging markets can think through right now.
Kun Thirachai, as for Thailand, if one of the major banks, were to go bust, what's going to be your recommendation? It means that the shareholders and also the creditors will have to equally, share the burden, and minimum dues, of taxpayers' money should be employed.
I think in Thailand we should look at this question today in order to prepare for tomorrow. And if say a bank should fail and it will require resources from the public more than have been gathered through deposit insurance scheme, then I think we should perhaps look at amending the law to allow the government to levy from the remaining banks who are the ones that derive the benefit from the government bailing out the banking system. I think that is one option. The other one is to think of the issuing or requiring the banks to issue bonds. These are called contingent bonds, whereby the holders of these bonds will be forced to be converted into equity, and the banks face difficulty. So that obviously the banks may have to pay a little bit higher than normal interest rate on these bonds, but it will also shield the taxpayers' money from having to bail out the banking system in the future.
And finally, Kun Thirachai, how the representatives of the emerging markets can have a bigger say, in formulating recommendations, on the regulations of the financial institutions, within the Financial Stability Board framework or within the G20?
Well, this is, in fact, the most difficult issue, and I'm trying to compare it with the work of the International Organization of Securities Commissions, IOSCO, whereby in which the Securities Commission of Thailand is a member. In the FSB, there is no process to gather inputs from the various regions, that is formal as yet. But say compared to IOSCO, IOSCO has 4 regional committees, and these committees act as focal points to collect information, to collect concerns, specific issues, and feedback from the members, and in order to report to the rulemaking body. I'm hoping that the working of the FSB and the G20 could be modified in order to allow for such mechanism, in order to gather more widespread views from the emerging markets.
Thank you very much for joining our program.
Thank you.